Hi, everyone. Thanks for watching a live episode with me. I'm Carrie Little, and I have my friend, Tina Abbatecola with Caliber Home Loans and the author of Home Buying. Of course, I had to do this. I couldn't resist.
Thank you.
The author of Home Buying, and I believe you can get this on Amazon. If you are in our market here in Illinois, you can find Tina in person. I'm sure you could grab it. But the stuff, here it is. The author of Home Buying, the stuff you could have learned if calculus wasn't a subject, an easy read on a boring subject.
Yep.
And so everyone should grab the book, and you should use it as a part of your value proposition when you work with your buyers. It doesn't matter what state you're in, having a conversation about the home buying process, especially from an experienced loan officer, it really makes sense. So Tina, tell everyone how long you've been in the business. And our goal is not to keep you here long, but our goal is to try to help you understand that FHA is not a bad word.
It is not. Thank you so much, Carrie. Thanks for the plug. I appreciate it. Yeah, so I've actually been in the business. It's 31 years, starting my 32nd year. And the reason I feel like I'm a little different is my first 10 years were in operations. So that means I was an underwriter, a processor, a closer, and an operations manager. So I have a very different view on loans when they come in, which is why I like to make sure we get all the crap out of the way first, make sure people really are qualified so that the rest of the process down the road is easier, I should say, not easy, easier. So, yeah.
And for those of you that don't know, if you are in Illinois and you get to work with Tina, Tina really does make the process simple. She actually likes people. She really does want you to be able to get into a home.
Mm-hmm.
So we'll come back to that because we'll make sure you know how to get in touch with Tina, especially if you're in Illinois, or if you just have questions, and I'll go grab the link. Here we go. I'll go grab the link to Amazon so people can buy.
You're so funny.
So the conversation is FHA is not a bad word. So let me start with this. As we're airing this in our industry, let's go pandemic, interest rates were at great rates.
Yep.
I mean, historical rates. And now, and again, I'm not a loan officer. I don't play one on TV, but I Google like, what could the interest rates be near? And so we're somewhere, let's say near 8% when we're having this conversation.
Mm-hmm.
But even before 8%, we were seeing multiple offers. And in our market, if the house is listed correctly, you could still eventually have a multiple offer situation, even if the house sits on the market for a minute because inventory is low.
Mm-hmm.
And Tina, you and I have had conversations around FHA versus conventional.
Mm-hmm.
And the real estate agents, and I'm just telling all of you, if you feel like Tina is being a little tough on you today, just take it with a grain of salt because we need all of you to have take a deep breath. So let me go with this question.
Yes.
You are a loan officer that likes to fully underwrite your clients. So when they go to write an offer, they're in a better position if they just had a pre-approval.
Correct.
That being said, sometimes you work with FHA, VA, or conventional, but
Mm-hmm.
oftentimes you'll have a client that writes an offer, but they're qualified FHA, and you have challenges with it winning the offer, or maybe even an agent saying you don't even need to submit that because my seller's not going to look at it. Why is it important to understand that FHA is not a bad word?
So I feel like a lot of the agents that don't like or understand FHA have been around for a really long time. And there's a part of me that understands why. However, just like everything else grows over time, FHA has grown over time. So the majority of the FHA guidelines, believe it or not, have stayed pretty consistent over the last 31 years that I've been doing this. However, when I started in the 90s, all we did was FHA and VA. That was actually kind of like a really big deal back then in the 90s because conventional was still like the 20% down and 3% was kind of a new thing. So there was mostly FHA on first-time home buyers. And back then, when the appraiser went out to do the appraisal, there was something called the VC sheet. It was like a valuation sheet that had plumbing, electric, roof and all these other things. So did you need a roof inspection? Did you need a plumbing inspection? There were termite inspections that were needed, and the scraping and the painting, but there was a lot more. There was at that point in time, but we're going back to the 90s. It has not been that way for, I think we're going on probably like 20 years now that it hasn't been that way. So what's funny is if you're thinking about it as the way it used to be, yes, I can understand why it would be threatening, let's use the word threatening, or why it would be, unattractive. However,
scary,
right? We're
a home seller.
Right. However, all of the appraisals now, including conventional, it's health and safety. So I just had one personally conventional that there was loose wires hanging in the garage, and the appraiser said you need to cap off and close up. I mean, it's a health and safety issue that you have loose wires. That was conventional, where a lot of people might not think that's the case, but it is. So the only difference truly really between FHA and conventional appraisal wise is the peeling paint. So if your house is in great shape and there's no peeling paint anywhere, FHA is not a scary thing at all. It's people remembering how the FHA was in the 80s and the 90s, not the current FHA, which is health and safety, just like conventional, and then the peeling paint. That's it. I mean, it's really not a scary thing with the appraisal. I feel like appraisal is the biggest reason why they're nervous. However, it's also good to know there are going to be properties that maybe don't, because of peeling paint is inside and outside. So if you go into your listing and you know that, these walls or the door frames or the whole garage, like, of course, then you can, that's a fair assessment that FHA is not going to be palatable for your seller because they have to do all the work. However, if you don't have that, honestly, that really is the only difference. Right? Not as scary.
So let me ask this question, because sometimes agents, especially the newer agents or any agent that has never dealt with FHA, because maybe they're in a market where property values are much higher and they're rarely dealing with FHA. When, here's I don't know how to say it because I'm older, Tina, and I forget things.
I'm pretty sure I'm older than you.
Right. It's right. It is what do I want to say, the untruth or the misconceptions of FHA. Sometimes people, when they see the word FHA, because it's not a bad word, is right. Well, they don't have any money.
That's correct. That is one of the, so aside from the appraisal, that'll be the next one. They automatically don't have any money, which is 100% incorrect. So what's funny is, if I may, a lot of the 20% down buyers that these same agents will argue, they don't have the money either. They're getting it from mom and dad or grandma and grandpa, or someone's giving it to them as a gift. So in reality, they don't have the money either. I mean, if you look at it from that perspective, right? Just because
they don't get it until they have to sell a house. That's when they might have that down payment. And it might not be true for everyone. Well, but a lot of times the misconception is that people don't have extra money down.
Well, I've even heard that about the 3% down conventional. I've had agents say, well, that means they don't have any money. No, it doesn't. And the argument I've had with the agents, the listing agents, is you don't know the situation. And at the time, especially when eggs were $8 a carton and gas was over $5, people don't want to spend all their money. Why are you asking them to take all of the savings they have, dump it all in so that your seller feels comfortable with a bigger down payment? And it doesn't make any sense. If they qualify for the loan, they qualify for the loan. Period. End of story. And if they're able to keep money in savings, who are we to tell people not to have money in savings after closing? That was the argument I would have with listing agents when I would call them. You're automatically assuming, just like my veterans, you're automatically assuming because it's a 0% down means they have no money. In reality, they probably have more money than everybody put together. They're good at saving. They're very disciplined. Like it's just misinformation sometimes is maddening to a certain extent. And there's there's no way to get around it. Like, because you could talk to people and they believe you and they understand you, but then they talk to like 10 other people who are believing the lie, and the lie is easier to believe because there's 10 of them versus one of you. That's
And
kind of the hard
here's
part.
the truth, is I had a client, years ago, pre-pandemic, and he only qualified FHA, but had 20% down. And there are reasons why people only qualify FHA. Like you were saying, one could be college student loan debt.
Yes.
Another one could be that maybe there was a bankruptcy. It could be went through a bad divorce, and you could have had just some challenges that only qualify you for FHA.
Correct.
And I've seen it in these side-by-side reports where you'll have one of the offers or two of the offers or three, and maybe a few people are only putting down the 3.5%, but then you'll have one that's FHA, they're putting down 20%. And the first thing the agent says, the listing agent, is, well, Carrie, why don't they just go conventional? It just might be a better opportunity or option for them to just go FHA.
That might be their only option. I talked to a lady today, FHA literally is her only option. She doesn't have options. Not everyone has options. So that's the funny part, is we say that we want everyone to be able to buy a house. If you really want everyone to be able to buy a house, then you need to be open to all the different programs that are available. You need to say that it's okay that a veteran puts no money down. It's okay that someone only does FHA for whatever their reason is in 3.5, or conventional puts 3% down. As you know, when people call me and they say, I want to, I'm a first-time home buyer, what do you have available? The funny part is conventional lets you put 3% down instead of 5%. That's a first-time home buyer program, but everyone overlooks that part. Like, that's not enough. They want more or whatever. But the reality is only a first-time home buyer can put 3% down conventional. It's 5 otherwise. So technically that's a program for first-time home buyers. However, I've heard these buyers are living on fumes. Like, I literally had one agent say to me, they're living on fumes. How do you know? Because they're only putting 3% down. You assume that the buyer's only living on fumes. So it would get kind of maddening. I did have the ones who would say, I already told the agent, don't even submit it. We're not even looking. It goes in the no pile. And to me, that was frustrating, because I'm not a realtor. I don't know, but I do know that I believe you're supposed to present all offers unless, whatever. So
unless directed by the seller that I don't want to see certain offers. But here's the deal, is you might as well show all offers. And I like to use like a Google sheet or a spreadsheet. I don't put the client's name. I just put I just kind of number them so I know who's who. And then I share the entire spreadsheet with the seller, and then we have a conversation. And I even had one seller go through and color coordinate everything. And if it was a certain color, these were the top based on our conversation. And at least one of them was FHA. Okay. Now I'm going to say this, my sister, who sold her house, had multiple offers in another state. And I'm like, are you looking at all offers? She was like, yeah, Carrie, one is FHA. I said, okay, let's talk about it. Like, as I'm, when it's someone, you step in no matter what. Yeah. And she was like, don't worry about it. The agent you referred me already told me at this point, the FHA is the strongest offer. Fully underwritten. Wait for it. No home to sell. And said they would only deal with basically the issues that came up in the appraisal from FHA. Sometimes we give up because we think FHA is bad, but that's not always the case. My first property in 1997 was FHA, but it was through a builder. And even though at that time it was 3% down, the builder still required that I put down 5%. Now, I didn't have the money. So what you said was true. Mom gave me the money, gifted me the money. But this was a program in 97. I had to pay every single month towards my down payment until I got to the 5%, which was like July through November. And I still actually, Tina, I still have that loan on that property. It's still FHA. I didn't buy a house yet. And I have a tenant in that house. Now you could talk strategy with any buyer, but I had to move. I moved. Yeah. And Mark bought a house, so the loan wasn't in my name.
Yep.
And it doesn't make sense for me to refi and pull out money. And matter of fact, I was still living in the property, and I did a streamline because I was at 5% or 5.5%, and interest rates were down to 3.5%. And this wasn't even recently. This was way pre-pandemic. And I was like, okay, fine, I'll refi. I was in the home, streamline. And why would I even get rid of this FHA? Why?
Right. And you
My
can
mortgage
actually
is
do
$500.
you can actually do a streamline on investment property FHA. So you can't purchase using FHA, but like in your situation as an FHA, as like if you wanted to refinance that right now, FHA, you can.
Oh man, so okay, just let me know when they listen here, I sound like a consumer. Let me know when they get back down to 2.5%, Tina. I'm all in. I got you. Now that's it, because I didn't even know, but this is why you need to collaborate with loan officers.
Yeah.
So I do have a question in the chat. Hi, Tina. This is Pam. Is there any such thing as a 0% down FHA loan? I've seen this being advertised lately. Thanks.
Hi, Pam. I saw it too, and it pissed me off. I'm gonna be honest with you. So yes, technically it's not really a 0% down. There is there's something called the Chenoa Fund, which is everybody's got their own version. We have a version of it. All the lenders have their own version of it. And it's you're doing your first mortgage still at 3.5%. So it's the 3.5% down. And the buyer is actually taking out a second loan for the 3.5%. So technically it's a 0% down, but they've got two loans. One is for 96.5 and the other one's for 3.5. And the reason it kind of pissed me off is because they're so expensive right now that I actually had a buyer over the summer. He was so adamant that he wanted to do the no money, but it was costing him and this is going back to July before the rates were where they were, and his rate was already higher as it was. It was like 3 points. It was going to cost him like $6,500 in points to get the $9,000 for the down payment. And I was like, but wait a minute. So I sat down with him and we went line by line, and ultimately, thankfully, he didn't do it. Here's the deal on that though. First of all, it's expensive. The points are expensive to buy. You're not even buying down the rate. You're just paying to get it. There's no skin in the game from the buyers. So of course, the more risk a lender's taking, the more expensive it's going to be. That's why you see those are higher rates typically, and portfolio products. We're taking on the risk that this is not something normal and we don't have someone helping us pay for this. So let's say the rate is 9%. I'm just making that up right now. On the first, that means the second's going to be 11%. So they're going to have a first mortgage payment, including taxes, insurance, and mortgage insurance. There's a second mortgage payment for whatever that. So like that gentleman I talked about earlier, that second mortgage payment was going to be $385. So not only did we save him on across the board, it all worked out. He only ended up bringing an extra $1,500 from what he wanted to, but he didn't pay points. He didn't have the extra payment. So again, I guess, and Carrie can attest to this, I'm very passionate about this. Just because programs are available doesn't mean they're a good idea. Okay. So and I also read one of the realtors posted this and said, FHA is doing 0 down and the person can refinance. Okay. So here's my question to that realtor who posted this. If they're putting no money down and they're already at 0%, if the rates come down next year, how are they refinancing it into a traditional when you have to have at least 3% equity in the property? You hope that equity goes up, but you can't automatically tell people that they're going to be able to refinance it. You can if you qualify. Sometimes you qualify, but your property doesn't. What if the value doesn't go up? So now they're stuck with that loan, and on top of it, all those points that they paid, you lost that money. Also, you could just
have had at least a new furniture set.
But do you see what I'm saying? Pam, I hope that answers your question. So technically, yes, it's 0 down, but it's not FHA is not really doing it. It's the Chenoa fund that goes along with FHA. So people have the option to be able to do it, but they're borrowing that money to do it. So they're not really, I mean, I don't think it's a good idea personally, but I mean, I don't know. And it's expensive. I feel like that's the biggest part for me is the cost of the extra fees as well as the extra payments for buyers. People are already, trying to navigate through making their payments the way they are. So to add this extra couple $100 in payment per, it's a big deal. And second mortgages can foreclose on people. You could not pay on your second. I mean, it's not easy, but they can. So if they don't pay on the second, but they're paying on the first, it still puts them in a bad situation. We have to be cautious about that. How are we positioning people for the future? Are we setting them up to fail, or are we setting them up to actually the things we talk about, to build wealth, to have things to pass on in the future, all that kind of stuff? And this kind of stuff it's kind of going backwards a little bit sometimes. It benefits some people, but it's a very small few people that would probably benefit from that, if that makes sense.
I look at it from this perspective. If you have someone that's tight on funds and they don't already have, first of all, because you still have to have 3.5% in the bank, right? To close. So that didn't go away.
No.
So you still have to qualify. And then
Yeah.
you're saying you don't want to put money down because now I just learned something new. You still have to take out a loan and you have to pay points. And I'm going to say a hard statement. It would almost be better for you to ask the seller to participate with closing cost credits,
Correct.
even in a market where you could end up in multiple offers. And then if you don't get it, move on to the next, because why spend the money? First of all, you have to spend your 3.5% anyway. Why not?
Yeah, that's what I did with that. That's what I did with that couple. We sat down and did a side by side. Here's what you're asking me to do for you. Here's how expensive it is. Here's what I'd like to do for you. The rate's going to be lower. The payment's going to be lower. The fees are going to be lower. And he only had to bring $1,500 more than he originally anticipated. And he was okay with that because he got to see all of it in front of him, that he saw that having the 2 loans and all that extra, when I told him he was going to pay $6,500 in fees to borrow $9,000, and it clicked with him. Oh, that doesn't make any sense, because he really isn't getting the $9,000 because he was paying $6,500, right? I mean,
so what I'm hearing is real estate agents need to take a second and work with a lender that's going to educate. At least go read the book.
Well, no, but I mean, it's just like, so I'm gonna bring this up. The Big Short is on Netflix until the end of the month. I watched it again. Okay. And just because.
What's the name of the movie again?
The Big Short.
The Big Short. I'm going to go through it in the feed.
Oh God, it really does have a very good timeline of what happened between 2007 and 2010, like who was involved, what was happening. But as someone who was living, watching the people around me offering these programs, it was so hard for me because I was not someone, I would not write subprime loans. I did not see the benefit in them because, again, were there people that potentially could have benefited? Yes. However, you were setting people up for failure because it was the same shit we're seeing now. You can refinance. Okay. What happens if the values went down? All the values went down like tremendously. People were upside down. They came up with HARP and all that because of it. So the people that were in those subprime loans weren't eligible for HARP. Those were Fannie and Freddie only. FHA had the streamline, VA had the streamline. So traditional loans, you still had outlets, but all those crappy ARMs and all that fast and easy and all the crap, everyone just was making money hand over fist, putting people in them because people wanted, the unfortunate part is it's up to us to protect the buyers from themselves sometimes because they don't know. They look to us. And if you're going to say, hey, I'll let you have this, it's super easy. They don't even care about what's going to happen in the future. They just know that I said, I'm going to give you this. It's going to be easy. They take it. And then later when they can't afford it, then they're upset that they can't afford it. And that's what I watched happen. So I remember being in my office and there was, at the time I was doing all FHA for the people who had, you know, that were trying to go subprime. We were doing, there was actually a program called Alternative A. It was called Alt A that was offered by Fannie Mae, which was really great. And then there was subprime. I didn't want to go subprime. So, and then there was FHA. So at that time, FHA was 6.5%, 30-year fixed, no points. And the subprime loans were 9.5%, 2-year adjustable, 2-year prepayment penalties, and most of the loan officers were charging at least 2 points on every deal. So you had to keep that loan for 2 years, otherwise you paid a big prepayment penalty. The whole premise was give those people 2 years to get their credit in order, and and they'll refinance into a traditional. But most people get used to a certain way. Okay, and then they didn't make them escrow. So they didn't pay their taxes. They didn't pay their insurance. Like, I watched it all implode from the inside, and it made me sick, and it still does make me a little bit sick. I'm grateful I didn't participate in it, and I actually was part of the cleanup crew that was there in 2010 that was helping and had to relearn the industry all over again because everything changed because of that. I think we've done a really phenomenal job in the mortgage industry with, I mean, there was a big overcorrection, but as far as like the loan officer compensation and not allowing loan officers to charge extra fees was huge. Again, I was not someone who did it, but it was great to see that part. The bad part is it took away from people like me who was willing to take less commission to give credits. That got taken away, unfortunately, as well. But it did stop the other people from being able to make, you know, be overly greedy and make money. And then also the ability to repay, which a lot of people get upset about, but it's our job to say we did everything we could to make sure that if this person goes into foreclosure, they can afford this property. We did not put them in a worse off position than they were before, like counting student loans that are in forbearance or loans that aren't theirs, that they're, all of that is for a reason. I explain that to people when I talk to them. I know some people don't want to hear it. They just want to get into the house. They'll do whatever, they'll sign whatever, but that's what happened last time. So when you're not paying attention as a buyer and you're not doing that, you're kind of putting yourself back in that kind of, you're almost like being your own worst enemy. And you're not listening to the people who are saying, hey, hold on, you've never done this before. Make sure, like the student loans is a big deal. All the people who haven't paid on student loans the last 3 years, they're all complaining now about the student loan payments. That's exactly why when we do loans, we always count payments, even though they weren't making payments, because we knew that when they came due, you had them, but we did our due diligence.
What I heard you say was, it is our job to protect the consumer.
Yes.
It is our job to protect them from themselves. Like,
yes, from themselves.
This right now in the real estate industry, I'm sure you're watching all these things play out. We are trying to figure out how to explain value. And I shouldn't say it that way. We need to go back to explaining value. And
Correct.
in addition to that, it's helping the consumer understand what they are buying. It is the largest purchase they will ever make.
Yes.
And a lot of times, you know, you'll have someone that wants the dream home today, when that it is absolutely okay to buy what's in your affordable budget. Because when people hear the word affordable, they think poor and broke. No, we just mean it's what's affordable for you. It might even be affordable for the community. And you might have to do FHA, and that is okay. Yes. You just need to ask questions, and it is okay to ask questions. And the moment you get to the point where you're like, I'm afraid to ask, is when you're going to be in a scenario where you are in a mortgage or something you can't afford.
Well, and we don't want to see that. And so going back to the FHA thing, I've asked and even at some of our events that we've had through, like, you know, Main Street and stuff, I've asked realtors, do you tell me honestly your sellers know what an FHA loan is? I don't, and if they do they really know what it is, or did they just hear you say we don't want FHA because the house won't pass or whatever? Did they really know what an FHA is and they really don't want to take an FHA loan?
Or it's because you told them. And what real estate agents don't understand is that people really do listen to what we tell them. So that is why if you do not know what an FHA loan is, even if your seller's like, I don't want it, take a second and say, let's talk about the difference between FHA conventional and VA. And here's what agents may not even be doing. You can go to the multiple listing service. I know at least our market, and I believe in Florida, I can do a column sort based on the types of loans. So there are some communities where you might have a closing cost credit and you might be FHA or conventional. So if I'm in a market where we're seeing more FHA deals that close with FHA, that means when I have a new seller, you can't go, listen, if you're selling in Hinsdale and you come over to my neighborhood where I grew up, Broadview, you are probably going to be accepting or looking at FHA offers. So if you are someone that is venturing out into different areas or communities, you can't take what you only do in one community and move it to the other. You got to do your research.
So, and then, yes, and let me tell you this. So let's say, for example, somebody who has a 680 credit score. It's not a bad credit score. They have a 680 credit score. Conventional has loan level price adjustments that we all saw. That was the big hysteria back earlier this year with the loan level price adjustments. So conventional looks at the property type, the loan amount, how much you're putting down, the credit score, and whether or not it's a primary residence, all that kind of stuff. But when you have a 680 credit score, someone with a 680 credit score might not get the same interest rate and won't get the same interest rate as someone who has a 780 credit score, let's say, right? There's a difference, or depending on how much you're putting down, like there's so much. That's why when someone calls and says, what's your rate today? I need to know this. If your loan officer is just spewing out a rate without talking to you, I always say run, because that means that person isn't putting in the time and energy to figure out who you are, what your needs are. They're just giving you a number. And if you're a transactional person, there's nothing wrong with that. But like for me, I'm a relationship person, not transactional. I'm not just gonna tell you something to make you go away. I want you to walk away going, damn, I just learned so much stuff. So the loan level price adjustments will affect the rate, but so does the PMI. So when they're putting 3% down and you have a 680 credit score, your PMI factor could be over 1%. So let's just say, for example,
wait a minute. So let me get this for all the people in the back.
Yes.
Your credit score plays into the factor of what your interest rate will probably be. Yeah. And then if you're not putting down a certain percent, let's say 20%, your PMI is also impacted by your
credit score.
Yes. This is why agents need to show up.
So let's pretend we have a loan amount of 300,000 and you have someone with a 680 credit score, and let's just pretend that the PMI factor is going to be 1.3%, because it goes the less you put down and the lower your credit score, the higher the PMI. That's $325 a month just for PMI, okay? So if you have the same person purchasing with an FHA loan, their mortgage insurance is $212.50 a month. And it doesn't matter.
I'll take the FHA.
But it doesn't matter if your score is 580 or 800. Everybody gets the same mortgage insurance factor.
Say it again. PMI versus mortgage insurance premium.
Yeah, MIP. So it's PMI versus MIP, because MIP is FHA only. So PMI is going to be based on your credit score. It's a factor that's based on your credit score and your loan to value. So the less you put down, the higher it is. The lower your credit score, the higher it is. And then it's multiplied by your loan amount. So if you have a $400,000 loan amount, take 1.3 times 400,000, your PMI is going to be $433 a month. So it's based on the loan amount. So the higher your loan amount, that makes a difference as well. However, FHA, everybody gets the same factor, regardless if your score is 800 or 580. You're getting the same factor. So that same loan, that person that's going to have the higher interest rate on the conventional, they're going to have the higher rate, they're going to have the higher PMI. So on FHA, you have the lower rate and the lower mortgage insurance. so for me, if I'm giving the buyers the opportunity, here's your side by side, and their payment's going to be a couple $100 lower on conventional, why would FHA? Why would they go conventional? Just because the listing agent and the seller want a conventional offer? So again, like, who are we to decide that these are the people that are going to be making these payments for the rest of their life? Not us. We're not making those mortgage payments.
So I need a new hat. Like I need a hat that says buyer. We, as real estate agents, and I have to often say, wait a minute, when you're, whether it's how we get paid, whether it's someone else's house, one of the best things my first managing broker said to me was, Carrie, it is not your house. You have to put on the hat of it is someone else's purchase. And she says she walked into a house, and I'm going to say it the way she said it. The house was painted in puke pink. She walked in, the buyer was behind her. And when she walked in, she said, oh my God. And the buyer was behind her and said, I love it. And she said, isn't it fabulous? You have to let people make their own decisions. It's not their house. And it is okay to, this is why I like Tina, is you make it easy for us. And if I have a buyer that says, hey, Carrie, I'm not getting it, I'm like, okay, what aren't you getting? And then I can shoot Tina an email and say, hey, Tina, they didn't get it. Because you closed one for one of our clients who had to wait and close and then still had to wait about 45 days to move in.
Yeah. But it's like, so that's a big reason why someone would use FHA is, again, what if it's saving them? What if that $200 a month is a big deal to that family? And it's not up to me or you or the seller to say, well, we want you to have a conventional, or even worse, we're not going to let your family have a house because you want to do an FHA loan versus a conventional, because that's ultimately what you're saying. Like, so I'm in a bunch of different, obviously, groups on Facebook, loan officer groups and whatnot. And there's a big group I'm part of for veterans where people are saying, I hope you're not shaking hands with a veteran and thanking them for their service at the same time, not accepting their offer, because that's a slap in the face. Don't say thank you for your service, but then you won't accept their offer because it's it was like, it's a great way of saying it. It's true though, too, because you're saying thank you, but then you're like, but I don't want you to have a house because I don't understand how VA works. I mean, the amount of misinformation, again, on a daily basis, like, I don't even know that could ever really change. I mean, you hope that it will. And there's always going to be people that'll say, I could do it or whatever. And the funny part is, as we were talking about earlier, is the funny part is that I want to let people know is FHA has their guidelines. This is what FHA, they have a book. This is what all the guidelines are. However, each individual lender, bank, whoever they're going to be, because FHA insures the loans, FHA doesn't underwrite the loans, they insure the loans. The lender is responsible for making sure you're meeting all the guidelines, and then FHA insures it and becomes your partner. If the person forecloses, FHA helps pay the costs for foreclosure. That's pretty much how that works. And so each lender, like when you go, well, my lender could do this on FHA, or my lender could do that on FHA. Sometimes that's true. There's certain things you can, but I'm going to give you a great one. FHA actually lets you go down to 500. In reality, 500 is the minimum credit score. There's very few, most mortgage brokers will have some lenders that'll let you go down to that. But what you never hear people tell you is FHA says if you're below 580 or 550, I can't remember which it is, you have to put 10% down, period. There is no 3.5% down anymore. Now it's 10%. How many FHA buyers will have 10%? Not a lot of them. But the funny part is, again, just like we said about the 100% FHA, you see out there, you could go down to 500, but are you telling people they have to have 10% down? So when you're like running off and running into on Instagram and putting this note, like, to me, that's why, like, I didn't run off right away with the 2 to 4 unit.
Okay, so wait a minute.
Yeah.
Before you go into the 2 to 4 unit, someone asked the question.
Yeah.
So then we'll go into the 2 to 4 unit.
Yeah.
Then we might have to to wrap up. I feel like we need a part 1, 2, 3, 4, and 5 with Tina. So here's the question. Can they use FHA if they need to repair items like peeling paint or GFCIs?
Yeah, so there's a couple different ways that could be handled. There's a certain amount, I don't have the details in front of me, but there's a small amount that you can actually get done that's able to be done without going into like a renovation loan. But then there's also the renovation loans, which allow you to do all of that work. So yes, there is a way to be able to do that, but there's it's like a certain value on the appraisal, and then you're able to do that. But the other thing is a lot of it has to be done prior to closing, unless it's like seasonal. Like if you're trying to paint a garage, that has to be done later. So you'd have to hold money back to do that in the future. So you need to make sure there's enough money in that appraisal to be able to do all that. So I wish answers were like black and white, but they're really not so black and white. I know.
Okay.
Yeah.
So yeah, I need to come back. We need to do this again. So the last question is can you address, everyone blew up on Instagram, and I was like, I think I'm just gonna watch. I think I'm just gonna watch what other people are doing. Talk about the multi-units and yeah, what happened? So what made everybody decide to create a reel or a TikTok?
It's a big deal. However, there's a big chunk missing right now. And so right now, conventional 2-unit is 15% down. This is primary residence, 15% down for 2 units and 20 to 25% down for 3 to 4 units, depending if you're using Fannie or Freddie. That's the current guideline. Starting November 18th, they said, we're gonna let you put 5% down on 2 to 4 units. That's a big deal. It is. However, and I saw it all over as well, but the reason I didn't jump on that is a couple things. One, like the minimum credit score is supposed to be like conventional 620, but I've seen all the emails from the PMI companies. Some PMI companies, because you need PMI if you're putting less than 20% down, some of the PMI companies want a 660. So you, even though the guideline says 620 and you can't get PMI, if you can't get PMI, you can't do the loan. So so that's one thing is, I don't think anyone's come up with their final. The biggest piece that's missing, those loan level price adjustments I mentioned earlier, they still have not told us what that's going to look like. So what happens if it's 3 points to do 5% down? Like, so you could put 5% down, but now you have to pay 3%, your interest rate is going to be 10 or whatever, or you have to pay all the fees. That part is missing. That's why I haven't listed it, because yes, it's important and it's great, but that's a big piece. What we don't know. Believe me, I've asked every day internally. We don't have, they have not indicated what those loan level price adjustments are going to look like. So to me, why am I getting everyone all excited about something? I always joke around and say, it's like bringing a donut to a Weight Watchers meeting. Hey, look, you can't have this, but look it, I'm going to flash it in front of you. Why do we do that to people? I won't do that to people. That's why you didn't see me. As soon as I know what the loan level price adjustment is, then I'm happy to share it with people. But until then, what if
take that video down, everybody? Take it down. That's what I'm just kidding.
I understand why people are doing it. Like, we're all, let's face it, I just did a little quick video last night. We're all doing the best we can to stay in front of people and stay relevant and things. However, we also are there's a lot of regurgitation going on, and you know, people don't want to be sold on everything all the time. And that's what I feel like I've when I talk to buyers, they're like, thank you for not being in my face. Thank you for not, you know, I love that you're a real person and you're not trying to sell me something. Like, I didn't even know you were a loan officer. You know, that's important, because when everything's coming at your face all the time, you get turned off and you don't even, I think that's where the reputation comes in for loan officers and realtors, is that we're all, you know, like these crazy people who are like in everyone's face, or the insurance people, like stay away from them. Like, I don't want to have people not want to talk to me just because I'm a loan officer. Sometimes I don't even say that in a room full of realtors. I just walk in, hey, and if you don't know me, I don't walk up and say that. I don't walk up, I'm a loan officer. Are you a realtor? Give me your card. Like, I don't agree with any of that. You know, relationships are real for me. That it's not a word. I've done it my whole life, my whole career. If people want to work with me, I'm excited to work with people. I'm not going to force anyone. I'm also not going to bullshit anyone into. You'll never hear me give false hope to anybody about any of this. And that's why you did not see me post about the 2 to 4 units, because I saw the PMI companies, and then I was also thinking about the loan level price adjustments, but that's just me.
So here
That's
we go. So
more
I
the
have a
operation.
question.
Yeah.
And then I'm going to give you a wrap up question.
Oh boy.
So Carrie says, I think I know, but can you confirm whether or not 20% is removed when if you have 20% in the property, can MIP go away with FHA? I'm going to say it that way.
Only if you put, so great question. FHA is if you put 10% down when you buy, but if you're doing the minimum, no. FHA does not, it's for the life of the loan unless you put 10% or more down.
In the beginning?
Yes, right when you're originating the loan. So if you bought a loan today and you put, like your gentleman put 20% down, he's going to have the mortgage insurance for a specific number of years. And then when he gets to that 22% equity position, it would go away for him.
So if I have a current FHA loan and I only owe 75,000 and the value is 320, does MIP go away?
Only if you were, so prior to a certain year, and I'll be honest, I feel like it was 2012.
We'll Google that. We'll Google it.
I can't remember. Yeah, I can't remember what year prior to that. So like in your 1997 loan, yes, it would have come off because it was like somewhere in the mid 2000s, early mid 2000s where they changed it. But otherwise, no. FHA. So that's another thing with FHA. It's temporary. Like most people that are in FHA eventually are going to have to, in order to get rid of mortgage insurance, they're going to have to refinance into a conventional when they have enough equity to do so.
Got it.
So yeah.
So that was a lot. I feel like we could, because this is what Google said, and I didn't use ChatGPT. It says, if you put down at least 10% when you bought the home, your FHA MIP expires after 11 years. Refinance into a conventional loan, replace your FHA loan with a conventional loan, eliminates the FHA's MIP requirement.
Right.
This is the only FHA MIP removal option if you put less than 10% down.
And that started in like I want to say 2013, maybe 2012, because prior to that, it used to come off just like it did on conventional, but they changed it. FHA changed it and made it for the life of the loan. So real quick thing I will tell you on FHA, when I started in the business, the upfront mortgage insurance premium that, you know, the one that gets added on to the loan, it was 3.8%. Yes, with no monthly. It was 3.8% with no monthly, and it flip-flopped all through the 90s. Then it was down to 3, and then there was a monthly added, and then it was down to 2, and then 2.25. And if you did home buyer class, they took it away, and then 15-year didn't have. It's amazing how what they've done with FHA and that kind of stuff. But originally it was 3.8, so it was helpful for people, but they were still paying for it. That's the funny part.
So Carrie has one more question, and it is, or Pam, Tina, is now a good time to take out a HELOC for home improvement? Now, you know, I have a Carrie opinion, but go for it.
So I always tell people when they call, because I've been getting a lot of calls for that, because people don't want to touch their first mortgage, and so they're doing HELOCs. It's good if that's what you need to do, but you also need to understand this. If you're going to want to refinance in the future, your loan in the future, consolidating both loans together, is now going to be considered a cash out loan, because you're taking the home equity loan and adding it to the other one. That's going to give you a higher interest rate in the future. Those loan level price adjustments apply also to refis. So you're going to have a cash out adjustment for that. And if you keep it, and if you're like, let's say you keep the line open, you also have to make sure that your bank will do what's called a subordination agreement. So let's say you don't want to combine the two, you just want to refinance your first. your second lien holder needs to agree to stay in second position, because if you have first mortgage, second mortgage, this one gets paid off, this one moves front, you need this one to stay here and the first comes here. So if your bank is willing to subordinate, you'd be okay. If they don't, that would be a problem. Again, I feel like those are the little details that people need to know now, so you don't run into the problem later, because once you took out the loan, you have the loan. So yes, I'm actually in the process of doing my own right now for my own home improvement, but I'm not looking to refinance. I don't care about the rate. I care about my payment. My payment's great. I won't refinance. So for someone like
my opinion is, and I know something, you know, if you take care of your home and you make the updates, it keeps the home, it keeps the value of the home.
Correct.
It's when people live in their homes forever and they never clean the furnace. They never, I'm going real bad on this one, clean the toilet. Because I've seen people with black toilets inside.
Oh, yeah.
Or you've never, you know, just the basic things, you know,
Yeah.
kept your baseboards clean or the windows clean
Mhm.
or the doors, or when you know it's time to replace the windows, you should replace the windows, or when you know it's time to replace, you know, update the bathroom. If we did things over time, it makes more sense. But I get sometimes you do have to take out that equity because you need an equity line of credit because you can, you know,
it's expensive.
You have repairs on the chimney or the, you know, the bricks.
Put in a
like
new
something.
furnace. Yeah, put in a new furnace or air conditioner.
My personal opinion is that whether you're a real estate agent or an entrepreneur, like even in your industry, if it makes sense for you to get it, go for it. But if
Agreed.
you know you're tight on funds, or the moment you buy, one of my tips to every home buyer is when you get paid, put money aside for the you don't know.
Yeah, it's true. Which is why I say, why are we asking our buyers to throw all their money into the down payment on a house and not have anything left over when they need to furnish, make payments and everything else, when they have the option to do less just because your seller wants them to put more money down? It never makes sense to me.
So here's my last question. What's one thing I can learn out of your book? Because it does say home buying, the stuff you could have learned if calculus wasn't the subject. What's one good thing, one benefit as a real estate agent and or a buyer? What do you make easy? How about, let me go. How about, we got a rent versus own section. We've got using the housing market to your advantage, negotiating with sellers. Do you have a favorite section?
Well, of course, the mortgage section is my favorite of all. I spent the most time on that one. I will tell you the one thing I think that's in that mortgage section that a lot of people don't know, and I even bring it up in my home buyer class, and you should see the looks on people's faces. If you've defaulted on any federal loans, which includes student loans, money owed to the IRS, or if you ever foreclosed on a loan that was backed by FHA or VA, you get put on a banned list. It's called a, yeah, see, exactly. I actually put that in there. And it means that you can't purchase until you've been taken off the list. You're in default with something, whatever it may be for federal, and you cannot use an FHA or VA loan moving forward until you're not on that list anymore. I did put that in there because I think that, and I bring it up in my first time home buyer classes, and a lot of people are like, but I check them on every single one. Conventional doesn't matter, but on FHA and VA, there's a list.
So with that being said, everyone should go out and it's $7 on Amazon. Like this, go buy, like, for your next buyers, go get the book.
You're so funny.
I say go get the book. So thank you, Tina. I really appreciate it.
Oh, hopefully it was helpful. I hope everyone learned and everyone's got my information, or if they don't, Carrie's got my
I shared it in the feed. They can find you on Instagram. They can find you on Instagram.
Happy to help in any way I can. Obviously, I will never give you false hope or lie. So thanks, Carrie. I appreciate you for the time.
Thank you.
See you later.